In Part 2, Larry is going to show you what moves the markets, and he'll explain his two best forecasting tools. In just a mere short 60 minutes from now, you'll more clearly understand how and why the markets function. Now, here's Larry.
Welcome back. In this section, I'm going to be talking about what really moves the markets. As I mentioned in the last videotape, I think that markets move for conditions. Markets just don't move out of whims. When actual conditions develop in the marketplace, that's why markets have big up moves and big down moves. So what I want to do now is to show you the conditions I've found over the last 30-some years of trading that are usually evidenced at major market highs and lows. And certainly the most important thing is to start with the commercials. Once a week, the United States government, through the Commodity Futures Trading Commission, releases on a website, which is cftc.gov.com, the results of the trading of three different groups. The commercials, those are hedgers. Large traders, which are primarily funds, and then what's left, speculators, small traders. So again, we get to look at what the commercials are doing. Those are the users, producers, the people who are hedging in the marketplace. Large traders, which in this day and age tend to be the commodity funds, like we have mutual funds. We also have funds that trade commodities for other people. Commodity funds would be synonymous with mutual funds. And the last group would be small speculators. And what I've done is made a career of studying what these commercials do, because the commercials have a pretty good record. They're not right all the time, but by and large, they are doing the right thing at the end of the market move. They are the trend enders. When the commercials get heavily, heavily short, markets go down. When they get heavily long, markets go up. So I want to start with that position to see if I can get myself in alignment with what these commercial interests are doing. There's a couple ways of doing that. First of all, we have just the basic data that comes out every week that shows what their net position is. We'll look at a chart now of the gold market. And interestingly enough, just before gold had the large up move in 2003, the commercials were long at the bottom. As you'll see on the chart, there's a dashed line that comes across here. That's above it is net long and below it is net short. As gold had been coming down, the commercials started buying gold, and sure enough, lo and behold, it ran up until they got heavily short gold, and then gold came down. In fact, if we were to squeeze up our time frame a little bit, we'll see that on the recent high, that was the most short position the commercials had for years, literally years. That was the largest amount of short position they had for, I think 10 or 11 years, which would tell us we would expect a high in the marketplace. By the same token, this buying was unusual. We had seen buying back in 2000, and again, gold had a big up move. Now, notice the commercials tend to be a little early on the buy side. They bought before the absolute low, and they got short before the absolute high. That's typical of what happens with commercials. They're early in the marketplace, which is fine, because what we want to use them for is a early warning indication of when we should start to be long or start to think about getting long a market or getting short a market. There's also something that needs to be pointed out about these commercials. A commercial is different than you and I. We want to make money by buying today and getting out in maybe 3 weeks, 5 weeks, something like that. We want to buy here and hope prices go up. Commercials are different. Remember, they're users and producers of the commodity. So they don't really care about an immediate move in the marketplace. If I'm, say, General Mills and I want to buy wheat so I can make Wheaties, if the price of wheat goes down, I want to buy more wheat, because I'm going to take that wheat and use it, and my cost of making the Wheaties is lower because I bought wheat at a lower price than I was buying it 5 months ago. So if it goes down a little bit more, what do I want to do? I want to buy more wheat, don't I? Because my cost of my product is smaller. So they're not speculators like you and I are. And you have to remember, they play a different game than we do. They want to take the product, the raw product, put it into candy bars or Wheaties or whatever it is, gold rings, and then sell it. So they're about markup. What's the cost of their product? So they're willing to buy a lot of weakness. It looks like, my gosh, they're wrong sometimes. Well, as speculators, yeah, they bought early. But as using the product and then redistributing it into something else and selling it, no, they're absolutely correct about what they're doing. So they tend to be early on the buy side and early on the long side. That's great. Or on the short side, that's fine. It just tells us to get ready. And when they get massively long, that's when we usually see very large moves in the marketplace. And when they get massively short, as we saw in gold, the largest short readings that they had in the gold market, starting in the 2000 bear market that lasted about a year and a half, and again in 2003, the week of the high was the biggest short position. Mark, if you would squeeze up the bars a little bit more, that was the largest short position they'd had for years and years, back to the high of 1997. That was the second time they'd been that heavily short. It's no wonder the price of gold came down. Interestingly enough, when gold was having that big run-up, the public, the advisors, was like, oh, gold's going to go to the moon, the world's going to crash. Oh, let me talk about that. What happens when we have a big crash in the stock market? What's gold going to do when we have the big economic debacle of all time? When I ask people that all over the world, they say, well, where there's a depression, when the stock market crashes, gold's going to go up. It'll go to the moon. That's one of the largest wives' tales of the economic marketplace. Because in the crash of 2000 and 2001 and 2002, gold went down. And remember, the stock market was down, as measured by the NASDAQ, about 75%. If you go back and look at the crash of 1987, that was the single largest one-week crash in the history of the stock market. Gold went down. If you go back to 1973, which is a huge bear market, 1970 bear market, gold went down. I know. You go back to the crash in 1929, well, do it. And you'll see that gold went down. So wherever this myth came from, that gold will rally when we have the big crash, is totally wrong. And here's a reason why. Because there's reasons for why things do things. See, in a depression, there's no money to buy anything with anyway. When gold does go up is during an inflationary time period. Remember when Jimmy Carter was president, interest rates were 18, 19%. We were at huge inflation. Gold went to the moon. So did silver. Because people were saying, I want a hard asset. I don't want paper. It's not worth anything. It depreciates because of inflation. And there's a lot of money to buy with. But during a depression, soap doesn't go up, gold doesn't go up, cattle doesn't go up. Nothing goes up because there's no money to buy it with. So just eliminate that idea. If we're going to crash in the stock market, gold's not what you want to get into. You want to either be short stocks or probably have no position at all, just on the sidelines waiting to buy when the lows come in. But wherever I lecture, it's just always amazes me how people say, oh yeah, during the big crash, gold will go up. Well, there's no evidence historically to suggest that that's true at all. So eliminate that from your mind. And we can usually tell when this market's going to have big moves, when the commercials get heavily long, as they did in 1999, big skyrocket up move in the gold market. That's a move worth per contract basis, and let's talk about that, Mark. If you were to buy one contract and your margin in gold back then is about $1,500, from this move you would have made about $7,600 in a period of maybe a month and a half, something like that. That's a type of bang for your buck you can get in this marketplace, because it doesn't take much of a move to, in this case, almost do 6-7 times your money. If you're right. Of course, if you're wrong, it can work against you the opposite way. But when we see these commercials start to get aggressively long, you should expect higher prices in the marketplace. But when they get heavily short, you'd expect the market to break to the downside. What we're looking at now is just the commitment to trader report. I'm going to show you how I make an index out of that, but let's look at another market first of all. Let's look at the S&P 500. Now, when we're looking at gold, that's a real market. We can break all markets down into two classifications. Natural resource markets, those are God-given markets, would be things that come from nature. And then we have what I call the abstract markets. Those would be things man-created, like the British pound, Swiss franc, Japanese yen, S&P 500, treasury bonds. Those are man-made items. They trade a little differently, but in terms of commitment to trader report, the commercials are equally good in both of these markets. Notice what happened in 2000. The commercials went to the short side and stayed short all the way down until they went long at the lows in 2003. Isn't that remarkable? And all the time people are saying, buy stocks, do this, do that. But if we look at what the commercials are doing, the guys with the most money in the business, the most professional people, they went short and stayed short all the way down. Covered in March 2003, and the market started a huge up move since that time period. So I pay a whole lot of attention to these commercials because they tend to be right the vast majority of the time, they're the most correct player that I can find in the marketplace. So I really have learned to pay attention to these people, either their net position as we see here or as an indicator. We'll also put it on wheat. That's been a very popular market. And we'll see what the commercials have done in the wheat market. Notice in the entire big down move, the commercials were essentially short most of the time in the large move to the downside of wheat since 1998. They got very long right at the low in 2002. Then we had a big up move in the wheat market, the biggest up move in the wheat market for years. Well, why did that happen? Oh, maybe because Mars was conjunct Saturn? I don't know. Probably not. What we see is the commercials have been doing more buying then than they had for the last 5 or 6 years. Then wheat took a shellacking and went down in the fall of 2002 and 2003, and it's no wonder because look what the commercials were doing. The largest short position they had had again for 4 or 5 years, and the price of wheat came down. Recently, in the middle of 2003, the commercials moved back to the upside, or as buyers rather, and later on prices went back to the upside. You could even take a smaller market like Kansas City wheat. We can see these commercials because, again, it's reported every Thursday on a website, and you'll see the net position of commercials long and short and see what happens in terms of even a smaller market. This is Kansas City wheat. Essentially the same thing. Commercials hadn't been buyers at all for a couple of years. They buy, up goes Kansas City wheat. They get heavily short, down come wheat, and then they start buying in the middle of 2003, spring of 2003, and Kansas City wheat starts to go to the upside. The commercials are just that good. Well, again, they can be early from time to time, and occasionally they're wrong for a little bit. But by and large, it doesn't matter what the market is. They're doing the right thing. If there's any market somebody would like to look at, just raise your hand. We'll go look at your market as well. It would certainly help the people at home to know I'm not hand-choosing these examples, just taking whatever. Yes, please.
Treasury bonds?
Treasury bonds. Let's look at Treasury bonds, one of the most actively traded commodities that we have. And notice what happens when the low is made in Treasury bonds. Right at the low, that was the largest buying the commercials have done for a long time. Notice what happened this year in 2003. That was the biggest buy point we'd seen for several years, and Treasury bonds just scream from about 110 to over 120. Why? Because the commercials got to the long side of the market. Currently, as this is being made in the latter part of June 2003, we notice the commercials move back to the short side. They're not heavily short like they were at these readings, but they have moved to the short side of the marketplace. But every single time that the commercials got aggressively long, look what happened, the marketplace went up. Same thing back here. This was the most buying the commercials had done for a couple of years, and that was a low point in the marketplace. Markets move for reasons. Commercials are the reasons markets move most of the time. These are the guys that are the captain of the ship. Remember when I did that little drawing of the captain of the ship? The commercials are the captain of the ship. It isn't that they manipulate the market. They don't do that. That's not what they're in business to do. But when we see they're heavy buyers, their staffs are saying we want to buy. We think this market is going to go higher. We protect ourselves by buying now for higher prices in the future. And that's why they are so accurate. Another market somebody like to look at?
Canadian dollar.
Canadian dollar. Let's take a look at that. Commercials got heavily short the Canadian dollar earlier this year, and this is a case where they've been wrong. One of the exceptions. They were right at the lows. They bought. Canadian dollar screamed. But when they started selling in here earlier this year, the Canadian dollar did not stop. Continued going up. Which means once we find a market that's set up as a Canadian dollar, wheat, or any of these markets have been, you still need something to get you into the marketplaces. Sell now. And that would be a change of trend, which we'll talk about in the third video series. We'll look at how markets change their trend once they're set up by the Commitment to Trader report. Another market we could look at with that would be soybeans. And which one did you want to look at?
U.S. dollar.
The dollar index. Soybeans present an interesting situation. Notice that the commercials got heavily short in here, the market stalls, and we don't see much happening in the market in here. The commercials don't get heavily long, they don't get heavily short. It's a little confusing in here. We'd want to be a buyer. Beans have a huge rally. They were long, but they weren't net long, like they were net long back here. So it's for that reason that I've actually made an index out of what the commercials are doing. We can look at the raw data as we do here and see that's pretty interesting what's going on in the marketplace, but I like to put this into an indicator so it's absolute. And I'll show you how I do that with the indicator. And I do this. We take the commitment to trader report and plot it on a chart. This is plus, their net long or their net short, and it's just the indicator you saw. It would be something like this. And what I do to make it normalize for all markets is to make an index out of it by doing this. I take the highest reading for the last 3 years. This is a 3-year look back, if you will. And I take, that's the highest reading, and this is the lowest reading, and then I take the current reading. Let's say that the highest reading was 60,000 and the lowest reading was 5,000. I subtract the low from the high, which in this case is going to give me 55,000. And then I subtract the current reading from the low. Let's say this reading is 20,000. So I subtract 20,000 from that, the low of 5,000 from 20, and I have 15,000. I divide that by the total difference from the high to the low of 55,000. That gives me a percentage of what percent the commercials are buying or selling now versus the last 3 years. So now we have a stable indicator of the commitment to trader activity, a stable indicator of what the commercials are doing that will fluctuate from 0%, they're not doing any buying at all relative to the last 3 years, or 100%, they're doing 100% of buying versus the last 3 years. Then we start to get a better insight into the commitment to trader report, and it's normalized. We can look at this over long-term data, and it isn't just that they're net long or just that they're net short, it's where they are within this indicator. Now, if we do that and look at the market we're just looking at, which was soybeans, you're going to see a whole different picture when we go to the indicator as opposed to the net position. The indicator shows that the commercials got short here, but were, Mark, let's put it like 75% long. The commercials reached our point of wanting to be a buyer in here at high levels and low levels down here at like 0% buying, and that was a high in the marketplace. So the 3-year look back of what percentage the current reading is versus the last 3 years is really helpful. Notice currently the commercials have been big buyers at this high prices, which is quite bullish for the soybean market. Those of you watching this after June of 2003 will be able to see what the commercials did. Go back and look at history and see what happened, but certainly the way to bet is the commercials have been buyers in here. Another one currently that's looking that way is sugar, I believe. Let's take a look at sugar if you would, Mark. Yes. Notice again, this level is above 75%. The commercials have been doing 75% of their buying versus the last 3 years. And down here it's 25%, so we would expect market highs in this area. Someplace after this happens, look for a market high in the market. Another market high. The commercials are heavily on the short side. Here we're looking for a market low. Gosh, here they were early. We have to deal with that, and we will when we look at trend change. Another great buy point in the sugar market. And Mark, just so people can understand at home how much that market is worth, a move, the margin's about $1,000 for this market. It goes up about $6,000 once the commercials get heavily long that marketplace. Even these markets, and we're looking here at a weekly chart, not a daily chart. Everything I'm talking about on this tape, and I believe the next one, we're looking at weekly charts to give us setups for major moves in the marketplace. We have another move down here. That's probably a couple $1,000 move from here to here, the $1,800 move. So there's a lot of money to be made in there when your margin is only $1,500, $800, $1,000. What is it, $800 for sugar? $750 for your margin in sugar right now. So there's a lot of bang for your buck in that market. Again, they get long and you get nice up moves in the market. Look for shorts in there, nice down move in the market. The commercials have a better record than anybody else I've been able to find when we put this into the index fashion to see when a market is most likely set up to be bought or to be sold. And again, it doesn't matter if it's a natural resource market or an abstract market. As an example, we'll go back and look at those treasury bonds somebody asked about. We'll look at treasury bonds on the index and we'll have more clarity because we see things just jump out. Like, look what happened back here. Before bonds took off, The commercial, as a percentage basis, were 99% long in the marketplace. And that little move in the market, Mark, is worth how much money? That's about a $10,000 move from here up to here. Clearly predictable by anybody that knows Larry Williams' material, because the commercials were extremely long the marketplace. And away went the bond market. The last time we saw them that heavily to the long side, another big move in the market. Back here, again they're heavily long, big move in the market. Look at all the commercial buying at the low. And away went the market. Look when they were the most short. Back here, and the market tops out for about a year, not quite a year and a half to the downside. So I really pay so much attention to these commercials once a week, get their report, which I happen to get on the Genesis data, and see what they're doing in the marketplace, because these guys are right market after market after market. Let's look at soybeans now, Mark. Did we look at soybeans? Let's look at gold and silver, disparate markets. Gold, the commercials got heavily short, as we saw earlier. Market top forms. They start to do a little buying in here. Market rallies, comes right back down because the commercials are on the short side of the marketplace. So we'd expect lower prices in gold coming into the second part of 2003. Silver presents an interesting scenario. Silver is primarily the public's version of gold. So you see a whole lot of public interest in the silver market as opposed to the gold market. And the commercials in silver get long at the lows. Get long at the lows. And look what they do at the highs. Sell the highs. Again, the commercials sold the highs. Didn't get quite down into the selling area in the last market, but usually these guys get short and the price of silver goes down. The problem, and you need to know about the problems with my material as well, is sometimes they get early too soon. We talked about that earlier, which is why we still need something to get us in. And hey, you know what? Sometimes you're going to be wrong trading. You're going to lose money trading, so we have to have protection, money management techniques. Say this one didn't work for whatever reason. New set of conditions came in, a new whatever happened, and so we're wrong. We have to have a protection mechanism for it as well. The last abstract market to look at would be the S&P 500. Remember, this market's been in a huge downtrend for a long time. If we look at it on the index basis, though, we see that the only buy signal came with the index was in March of 2000, March 28, 2003. That's the first time the commercials got aggressively long in the market since before 2000. Usually when they get aggressively long, as we saw back in 1999, markets rally. In 1998, the commercials got aggressively long and the market rallied. Now, to give you an idea, those who don't trade the S&P contract, had you bought one contract, well, go here, Mark, at the low here and come up to not even the full rally, that's a $100,000 move. It's a huge move. Had you bought down here in March of 2003 at the low, that's about a $33,000 move, $35,000 move. So that much move is predictable based on what these commercials are doing. Now, the other side of that's equally true. If the commercials are heavy buyers, markets tend to rally. If they're heavy sellers, check this area out. The commercials got heavy on the short side here, and look what the market did. Big collapse. That's a move probably worth $60,000, $70,000 to the downside. Pretty predictable because the commercials were $92,000. The commercials were heavy sellers. They're doing less than 25% buying. The last time that occurred was back here prior to September 11th, 2001. And again, the market, because the commercials are heavily short, collapses to the downside. That's another move of probably, $70,000, $80,000 per contract. Pretty predictable because the Commitment to Trade report showed these guys were heavily on the short side of the marketplace. When they're heavily short, especially in a downtrend, I don't want to be a buyer because the bet is it's going to continue going to the downside. Most markets are that way most of the time. The commercials are just that powerful in the marketplace. We looked at Kansas City wheat a minute ago on the total Commitment to Trader report. We'll look at it now on the index report, and you'll see the little difference in there. Clearly, the commercials are heavy buyers at the lows, the most buying they had done for 3 or 4 years. Big run up in the market. They get short. We want to start to take sell signals in here. They get long. We let them stay long a little bit and take buy signals. Currently, they're in the high end. They've been doing a lot of buying in the marketplace. We don't want to be selling this market short because the commercials have been on balance buyers in the marketplace. Now, when I first started following this, and my mentor Bill Meehan told me a lot about it, we got the commitment of trader report once a month, and it was 1 month late. So it was like almost outdated, but it didn't matter. Bill said, it doesn't matter, Larry, we don't get it right away because these guys are early anyway. And then we started to get it every 2 weeks, and now we get it every week, and it's really nice to be able to look at it, but there's no rush that you have to do it like today or tomorrow. It's a setup tool. See, I think markets move like this. This is so important. Markets get set up by conditions, the commercials and some other things I'm going to teach you. Then after it gets set up, then it starts its up move. So we go, oh, it's set up. It's like, oh, there's a fish in the fishing hole. Catch your worm in there, and they wait and wait and wait. Oh, nibble. Okay, good. Now set the hook and let the market start its up move. So I want to have a bunch of things ready to tell me this market's most likely to move up. Now, within that commitment to trader report, there's also another, remember the two other categories there. There's large traders and small traders. The definition of a large trader is anybody who's buying 100 contracts or selling 100 contracts or more. It doesn't matter if it's 100 contracts of the S&Ps with a margin of $20,000 or 100 contracts of oats with a margin of maybe $500. It doesn't matter. What matters is that 100 contracts or more, and then less than 100 contracts would be small traders. How would you like to become a large trader? Would you like to be as good as a large trader is? Wouldn't that be great? Yeah. So now I'm going to show you the large traders. The large traders tend to be the mutual funds and some large individual traders. And their record is kind of interesting because look what happened. The large traders, Mark, let's put that on the index basis. If we look at the large traders, strangely enough, they're not right very often. And there's a reason why. The funds are trend followers. So they'll buy a little here, buy a little here, buy a little here, and they have all their position on close to the end of the trend. They don't do all their buying right at the end of the trend, but they've added to their position, added, so they tend to be out of balance. They are the most long at the end of a trend. Notice when they got most long was up here in this trend. And when you wanted to be a buyer of Kansas City wheat, they were heavily on the short side of the market, weren't they? They were heavily on the short side at the low. Well, that's pretty interesting, isn't it? And there are big buyers up here when you probably didn't want to be a buyer. Remember, this dashed line, more than 75% of their activity is on the buy side. And when you wanted to be short, they got short over here, the market rallied for, again, each line is a week for probably 13, 14 weeks. So large traders are probably not what you want to be. However, an interesting thing will happen. You'll call up your broker and say, what's going on with the wheat market today? Let's put wheat up there if you would, Mark. What's going on with the wheat market today? And the broker will say, well, I'll go to the floor and find out. So he goes to the floor, and the guy on the floor says, oh, the large traders are selling the market or buying the market. You say, oh, okay. That's like a short circuit of the logical process. You say, okay, you accept your fate because you just heard the large traders are doing it. If you don't understand, are the large traders good or bad? Look what the large traders did recently in wheat. They got short right at the low. Isn't that something? Well, worse yet, they were heavily short before the largest up move that we've seen in the last 7 or 8 years in the wheat market. But when somebody says, oh yeah, the large traders did this, and people say, oh, okay, it reminds me what happened a few years ago. I had a friend who was a broker, had a problem. He had a drinking problem. So they made him an analyst. That's good enough to be an analyst in most brokerage firms. But whenever people had a question, they'd call their broker and say, well, you talk to our analyst. And they'd call this guy up. He had a real gruff voice and they'd say, what's going on with my soybean today? And he'd say, the Russians are in there. Oh, okay, that's fine. Thanks for the answer. The next call would come in, why are soybeans rallying? It's the Russians. Next call would come in, why are soybeans declining? It's the Russians. It didn't matter what the market was. He always said it was the Russians. And people said, oh, okay, then they understood everything, right? This is like that short circuit of the logical process. Well, the same thing will happen with commitment to trader report or large traders. People will say, oh, they're doing this. But they don't check the facts. They don't look at the actual facts of what's really going on in the marketplace. Let's take a look at the bond market, see what the large traders have been doing in the bond market. The large traders got heavily short right there when you wanted to be heavily long. Remember, that was a $10,000 move in there. And large traders got heavily long here when the market declines and heavily long up here just before the market does decline. And they got heavily short right here at the low in the marketplace. So large traders don't have nearly as good of a trading record as you might think. So if somebody says the large traders are doing such and such, well, either it's some guy with a drinking problem who's substituted large traders for Russians, or it's somebody who doesn't really understand the data. Always check the data, see what the data itself says. The S&Ps have been an interesting example because you'd think the large traders, the funds, would do pretty well, right? But the reality of mutual funds, remember, is about 85% of the mutual funds don't do better than if you just bought the Dow Jones Industrial Average yourself. That's a staggering figure. 85% of the funds don't outperform the Dow Jones average. And if we look at the large traders, we see the large traders had a unique ability to be short at the bottom in 2003, to be short in last October 2002 when you really wanted to be long, and they loved to be a buyer up here as the market declined all the way down. So the large traders don't have nearly as good of a record as you might think. We probably would want to do the opposite of what the large traders are doing and try to mimic the commitment to trade report, what the commercials are doing. The commercials are the kingpin, they're the driver of the ship. Any other markets you'd like to look at? Or?
Who are the commercials in this?
The commercials in the, good question. In the abstract markets, the commercials, of course, aren't users and producers, but they're mutual funds, and primarily in the S&P report recently has been large international banks not from America. The commitment trader report will show in a currency, it's large multinational companies and governments who are protecting their currency or pushing their currency to the downside. So governments, banks, institutions are the commercials in the abstract markets. And in the natural resource markets, it's the producers and the users of the commodity that are the commercials in the marketplace. Any other markets somebody'd like to look at?
Coffee.
Let's take a look at coffee, see what's been going on in this. Easy to predict the coffee market. Just go to stand in the line at Starbucks and see what's going on. Isn't that amazing? $4.50 for a cup of coffee that cost them like 13 cents to make or something, but they made a fortune out of it. On the index basis, it's interesting, we're able to find that the commercials get long here. This is the large traders, I'm sorry. The large traders get heavily long right at a market high. When you want to buy it, they're heavily short. When you don't want to buy it up at this high, there they are, the most bullish that the large traders have been since back here at this big crash in the marketplace. The only question about the large traders that I have is, how do they stay large? Right? But again, remember, because these tend to be the funds, they tend to be the most short at the end of a market decline when you want to be a buyer, because they're trend followers. The more the trend goes down, the more short position they'll have. The more trend goes up, now they're heavily on the long side, major high in the coffee market. Major high in the coffee market. Coffee's a wild swinging market. It's a very volatile market. I should point out that we have these markets called New York markets, things that trade in New York: coffee, orange juice, cotton, cocoa. Pretty speculative markets. Those of you who are starting trading, I wouldn't go into those markets right away. There's not a lot of liquidity in those markets, so you have a lot of slippage. You say, I want to buy at 63.10, and your fill might come back at 64.30. Pretty thin market, so be careful of those New York markets. They're not for people just getting in this business. Stay with the grains, the meats, things like that, treasury bond. But again, we see the same thing. Doesn't matter what market we look at. The commitment to trader report shows that these large traders tend to be wrong most of the time, and the large traders, let's put the commercials on, Mark. The commercials tend to do the right thing in the market most of the time.
How about cattle?
We'll look at cattle in a moment. Notice the commercials got short up here at the high when the large traders were buyers. The commercials got long back here when the large traders were sellers. The commercials got short back here. If you recall, rewind your videotape, the large traders at this point were heavy buyers, not the commercials. They were heavily short. And we'll take a look at cattle as well. Cattle is interesting because I've read a lot of reports where people say, oh, the commercials aren't any good in cattle market. Well, don't listen to me. Don't believe what I say. Don't believe what anybody in this business says. Look at the data. Check it out yourself. See, are the commercials any good? Notice that this was the largest buying they had done for over a year, and the market rallies. At this low point, they're buyers, the market rallies, they get heavily short, big decline in the cattle market. In fact, that's the decline mark for what amount of money we're looking at from here to here. About a $4,600 on a $400 margin. I'll show you a really interesting example. Mark, let's go back to the infamous trade, do you know as well as I? We had a huge decline caused in the cattle market in 1996. This was caused by a Montanan right here. When I ran for the United States Senate in Montana, there was a guy from Great Falls, Montana, who ran for Congress. Remember his name? Howard Lyman. And Howard was on television. Now, can you imagine a Montana boy was on television talking about cattle prices, and cattle went down from here to here. That was the television show that Oprah insulted a cheeseburger on television. Remember that? And Howard Lyman was on there, and he said, oh, yeah, I don't eat beef anymore. I used to raise them, but you shouldn't do that. They'll kill you, eat a cow, whatever. And that caused this huge decline in the market. Well, the reality is, look what the commercials were doing just before the Oprah Winfrey show. They were short the market. And the market went down, and look what they did. They bought the market, and the market went up. So the commercials tend to do the right thing most of the time. They've had a really good record. Like anybody, they can be wrong from time to time, but you see commercials buying, you got a rally coming in the marketplace someplace in the not too distant future. They've had a good results, and whether it's pork bellies or hogs or cattle, that's my first big gun, is to find out what the commercials are doing. And I want to look at it in the index, where I simply take this week's reading and subtract from that the lowest low of the last 3 years, divide that by the highest high minus the lowest low of the last 3 years. That puts it in a percentage or index basis. When we get above 75%, I say the commercials are buying. I want to look to be a buyer. When we're below 25%, commercials are selling. I want to look to be a seller in the marketplace. I don't rush out and do it immediately today just because that value is there, but that's the first setup. It's like a combination lock, like click, click, I got my first number in place. Then I go click, 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 get 3 or 4 numbers in place, and then I'm ready to take action in the marketplace. These guys have been way too good over way too long of a time period. Remember, I started using this in 1970. That's 33 years ago. With monthly data. It worked then, it works now, it'll continue to work in the future. Why? Well, simply because the commercials are the driving force of the marketplace. It's always going to be that way. They always represent where the majority of the money is. They're the guys with the brains. They're the guys with the trains. To make money in the market, they'll buy wheat in Chicago and put on a railroad train, take it to Kansas City or Minneapolis or Chicago someplace and sell it there. And all I've got is a computer and a chart book, so I figure the guys with the trains got the brains. And I want to follow what the commercials are doing. They're the starting point of all this. Recognizing that the large traders tend to not to be very good. And then we have the small traders, which like you and I, the public. The public does a really bad job most of the time. All I have to do to make you people successful as commodity traders is so simple. Get you to do the opposite of what you've been doing. When you call your broker up, instead of saying buy when you want to buy, tell them to sell, you'll probably do better. Most people just do the wrong thing all the time. They repeat the errors most of the time. You just have to learn the way the markets move, which hopefully you're going to learn in this tape as well as the next one. Then you're in alignment with what's really going on in the marketplace. Well, there's another group that I also like to follow. We have the commercials. They represent the smartest money in the market. Then I want to look at the dumbest money in the market. Now, who would be the dumbest money in the market? You people? No, somebody even dumber than us. Investment advisors. People that write newsletters. They just have the worst track record in the whole world. And it's always been that way. Owen Gartley started looking at something called odd lot short sales in the stock market in the 1930s. An odd lot short sales less than 100 shares of a stock. So Mr. Gartley figured, well, less than 100 shares means it's the public. And he followed odd lot short sales, and sure enough, when the odd lotters were doing a lot of buying, prices went down. When the public was doing a lot of short selling, prices went up. And some other work was done with that, but most notably Marty Zweig and a real good friend of mine, Wally Hybe, did a lot of measuring the public sentiment. Then Jim Sibbett in Los Angeles with a newsletter called Market Vein started actually adding up how many newsletters were bullish and how many were bearish on cattle, corn, wheat, whatever, just for commodities. And got a pretty good indicator of telling what's going on in the marketplace. I started doing this in conjunction with Genesis for stocks as well as commodities. And we'll look at this, both stocks and commodities. And what I found out is when a vast majority of these advisors are really bullish, they're probably going to decline. When the vast majority of them are really bearish, we're probably going to rally. Mark, let's expand up our chart a little bit. We can open it up and see a little bit more. Again, the dashed line would represent that more than 75% of the advisors are bullish on cattle, and look what happens to cattle. Down it comes. And at this point, nobody wants to buy cattle. We only have 11% of the advisors are bullish on cattle, and that's a low in the cattle market. The investment advisors, the guys that write newsletters, guys and gals now that write newsletters, don't have a real good record of being right in the marketplace. I first showed this index in a book with Bloomberg, the media giant, now mayor of New York City, about 4 years ago. And the index is unchanged from that time period. And it's amazing to see time after time that, yep, there it is. That's what the advisors, when they're 90% bullish, you're probably going to decline. When they're 10% bullish, only 10% of them are emailing you, say, go buy wheat, whatever it is, you're probably going to rally in the marketplace. Any markets somebody'd like to look at? We'll take a look. Lumber. Oh, now there's a real thin, tough market. I have my challenge for me today. Well, let's see how the advisors have done in the lumber market. Back here, you probably wanted to be a seller, but they're at about 79% bullish. At this major high over here, they are 90% bullish, and look what lumber does. It falls out of bed. They get bullish in here or bearish in here for a little bit. The market stops going down, bobbles a little bit. Again, they get only 22% want to be a buyer, and lumber starts a big rally. Just amazing to see these guys at a low when you'd like to be a buyer. They consistently don't want to buy lumber. They would prefer to see you be a buyer up here where 99% of the newsletters we measure were saying, go buy lumber. And down comes lumber. Somebody give me a stock. We'll look at some stocks too, just so you can see this theory of market sentiment is so important, whether it's a commodity or whether it's a stock. Just name out any stock you're interested in.
General Mills.
General Mills, okay? I have the index for most all stocks that have options on them because we use the option data in there as well. I don't have it for some of the real junk stocks, but we can look at it for most any stocks. Okay. The last time, most recent reading where the advisors were saying don't buy it was right down here at about $44 a share, and it's run up to about $50 a share. Recently, they wanted you, at this point, they were saying you buy it. 72% of people saying, look, go buy it. And what happens, it goes down. The all-time high we saw a year or so ago, leading into that high, 91% of the people are saying buy it, and it comes down. So I'm really cognizant of what these advisors are doing. When they get really bullish on the market, I got to say, you know what? I better hold off in here. It's not the ideal time to take action in the marketplace. I'll show you one of my favorites, Microsoft. Have you heard of Microsoft? Little company in Seattle, right? Well, it was an interesting experience in my life. It was Christmas time. And where I live in Rancho Santa Fe, California, they had one of those living crush scenes. And we're all lined up to go through it. And there's maybe 1,000, 1,500 people in this line, moving pretty slowly, going through the line. Well, look at this guy behind me. I said, that couldn't be. And I look again and say, you know what? Nobody dresses that nerdily except Bill Gates. And it was Bill Gates and his wife and daughter were behind us in line. And so I'm kind of, looking at him. It was interesting. He was really nice. His daughter, he'd bend down, talk to her, and I was pretty impressed with that. And so I'm looking around for security. I've been with presidents. I've been on Air Force One in the White House. I think I know what to look for security. I don't see any security at all. He's just out with his family for an evening. I thought, whoa, that's really interesting. And then I talked to him. He's a very pleasant guy, and I started thinking, well, he didn't have to stand in this line. He could buy every church in San Diego and buy his way to the front of any line he wanted to, any place in the world. Why is he doing this? And then I realized that the price of his stock was right here, and he was probably the third or fourth church he had been to that night. It had come down from $100 and some a share. But also, look where the advisors were at that point. Only 11% of the people wanted you to buy Microsoft as it started that rally. If you go back, Mark, to the all-time high in Microsoft, you'll see a really interesting development. Look what happens back here. This week we have 91% of the people that we measured were saying you should go buy Microsoft. What a difference investment sentiment makes. See, that's the emotional response, because our minds work like this. All of our life we've been told collect data, collect data, collect data, collect data, make a decision. When it comes to the market, the more it rallies, the more it rallies, the more it rallies, we say, yeah, it's bullish. And just about the time we say it's bullish, it ain't bullish no more. In this business, you have to be a buyer when it looks bad, not when it looks good. Most of you wait until it looks really good. Oh, everything is there. It's all the lights are green. And they all get green, and then guess what? They're going to change the lights, turn red on, and you get in a car wreck. You've got to get in when your emotions are telling you, oh my God, it's the scariest trade I could have. Those are the best trades. On my commodity timing hotline, we found one thing. Nobody takes the winning trades. Everybody takes the losing trades. We don't even put winning trades on the newsletter anymore because nobody would take them. That's just a joke. But it's really interesting. There's some fear going on. We're afraid. The trades you are afraid of are the best trades to take, without a doubt. The ones you say, oh, that's a slam dunk trade. Mortgage the house. Hey, Ma, let's get a second mortgage as well. This is the big trade of all time. That's the bad trade. It's just when all the data looks so good to you, when all the jury has come and said the dirty dog is guilty, he isn't guilty probably, that we have to be contrarians. And all of our life, it's the other way around. Well, I talk to my lawyer, my real estate agent, my banker, my wife, whatever. We'll get all these ideas and say, okay, now take action. In the marketplace, especially in the marketplace, we think they know more than we know, right? Gosh, they wear a coat and tie and vest, you know, and they have a bank with a real fancy address, and you think that they know more than you know. But here is a reality. There's the reality of investor sentiment. The reality is you've seen the large traders tend to do the wrong thing most of the time. The newsletters, the people you're paying good money to listen to, most of the time when they tell you to buy, it's a high in the marketplace. Because time after time after time, particularly in commodities, and we're really indebted to the work that Jim Sibbett did. Genesis also has an index of investor sentiment. Mine is a little faster. Let's put yours on as well, Mark. And I've tried to make mine more responsive, because one thing I think's happened over the years, maybe it's because I'm getting old, but it seems to me everything in life has sped up a whole lot from when I was a kid. I mean, everything happens faster. People get married quicker, divorce quicker, lose money quicker, go bankrupt quicker, reinvent themselves quicker. It's like the Madonna syndrome. How many roles has Madonna been, you know? That happens with the markets. They're really volatile markets. So mine is a little shorter term. The Genesis one is a longer term, so I'll get signals like they won't get a sell signal in here, I'll get a sell signal. They get the commercials, the newsletters are really bullish up here. I get it as well. We both get they're wildly bullish, and of course the market declines. But there's slowers. Mine will bobble around a little bit. There's a little slower version. Notice what happens at the lows. All the newsletters say, no, we don't want to be a buyer, and of course that's when the stock market takes off. I was fortunate enough to buy stocks at the low in March of 2003, the day of the low. Got lucky, I'm certain. In part, I did it because there's another measure of investor sentiment, which is a measure of the, every day on a website, the Association of Mutual Fund Owners polls their members, and all the members say that own mutual funds, stock mutual funds, if they're bullish or if they're bearish. And that was the most bearish they'd been for like 15 years at the low in March of this year, 2003. And when I saw that, I said, boy, that's the time to buy. Because when was everybody bullish? 1999, 2000, right? Everybody was bullish back then. Everybody was in the stock market. Everybody had a reason it would go higher, and it's the everybody syndrome I want you to be careful of. When everybody wants to do something in this business, it's probably the wrong thing to do. You just have to reorient your thinking, because most of our life is thought, oh, if everybody's telling me to buy, it's probably right. But as we see, if everybody's telling you to be a buyer up here, which is right in here, this is wheat, that's the high in the wheat market. When nobody wanted you to be a buyer, you're a buyer here, and that's when the wheat market rallies. I think it was Bernard Baruch who said, I buy my straw hats in the wintertime. Remember that saying? Have you heard that? That's really what we need to do, is make certain that we do the opposite of what the majority do. Because the majority can't be right as speculators. Remember I talked about how this is a very risky business. A lot of people lose a lot of money. That means we have to do the opposite of them. We want to get that money they're losing. So how do we do it? It isn't a question of being too bright to figure that out. Find out what they're doing and do the opposite. When they're being a buyer, we probably want to be a seller. Because if a lot of money is lost here and the government tells the Commodity Futures Trading Commission says it's really risky to do what we do and a lot of money is lost, it's being lost to somebody, hopefully to us. And we get that money by doing the opposite of what they're doing. And when we see these guys heavily on the long side in the wheat market, look what happens. Wheat market goes down. So I want to stress upon you the importance of the positions of these people. Now there's another way we can also look at the positions of the commercials as well. There's something that also shows in virtually every newspaper that does commodity figures, and it's called open interest. Let me show you how open interest works. Open interest. Open interest measures how many contracts are open in the market. About 60% of the volume in the marketplace is the commercials. The other 40% is the public and the funds. So open interest usually reflects what commercials are doing. You got to keep that in mind. Open interest is probably what the commercials are doing. Then first, it's 60% equals commercials as an operating number. And the other thing is commercials usually are selling short or hedging. So they're usually selling. So if open interest is increasing, they're adding to their shorts. If it's decreasing, they are reducing their shorts. Mark will go in a moment to cotton in July of 2001. What I like to see, what my mentor Bill Meehan taught me was this. He said, Larry, if a market's in a big downtrend and goes sideways and open interest starts to increase, the trend is down. And commercials are adding to their short sales, I expect the breakout to come to the downside. That's the open interest setup trade. Big downtrend, sideways market, open interest increases. Bill taught me by about 30%. In the ensuing years, I'd say if open interest increases 20%, that's a pretty good number to look to take action to sell short now. So big downtrend, sideways market, open interest increases, look for a sell. Based on the commercials, just telling you, get this in the newspaper every day. Here in Great Falls, Montana, a little itty bitty town, or New York City, or wherever you are, it's there. The other side of that would be a market that's in a big uptrend and the market goes sideways and open interest starts to go down by 20%. The commercials are doing less of what they usually do. Remember, they're usually selling short. Now they're doing less. So we're saying, hey, they're covering their shorts. We're probably going to break out to the upside and this market should rally. It doesn't take a rocket degree scientist to figure out in a market like this, as the market just breaks out of that zone, starts to go to the upside, probably want to get long. Now we'll look at a couple of examples, and you can look at open interest itself. Mark has cotton in July of 2001, and look what happened. Market's in a big downtrend, goes sideways for about a month. Open interest starts to increases again in this sideways market in a downtrend. It's no wonder that cotton went down, and that's a big move. That's a move of about what is that, Mark? From in here, that's a $4,000 or $5,000 move on a $1,000 margin in the marketplace. Clearly indicated. Commercials are selling the heck out of these trading ranges, big trading range, and open interest increases. You want to take any breakout you can. Any sell signal you want to see, you want to take. Mark, let's go look at the silver in 1985. Silver's in a downtrend, open interest increases, and the market declines. Notice when open interest decreases here, the commercials are covering their shorts, the market rallies. When they steadily add to their short position, that's when the market starts its decline. Open interest increasing, especially in a downtrend, goes into a trading range, that's when we want to look for the market to break to the downside. Let's look at cattle in February and March 1996. You can see an example here as well in 85, but look at this. Are we in a downtrend? Sure aren't we? Even any kid can say, yeah, price has been coming down for quite a while. Look at open interest increase. You want to sell. The commercials are hugely adding to the short position, and cattle from $70 to $60, which is a move of about $4,000 to the downside. Clearly shown by the fact that open interest is increasing in a downtrending market. We can go look at even currently right now. We'll look at look at Treasury bonds in March of this year. It was another interesting example of this happening. That open interest in March of this year starts to, we're in a big uptrend. Here we are, big uptrend in the market. Squeeze the bars up a little bit, Mark, if you would. Big uptrend the market's in. Look what happens to open interest. In this trading range, open interest declines, and away goes the bond market. That's a huge move of about $20,000 in your $3,000 investment. $11,000, I'm sorry. And you see, again, as the open interest increases, that's the market's run into trouble. But in a trading range, and this open interest drops off, expect the market to move to the upside. Let's look at silver, Mark. Current silver. Silver had a big trading range affair up here this year. It had been in a large downtrend. And look how open interest increased in the marketplace. Huge increase, trading range affair, and down comes the price of silver. So, and it's in your workbook. You'll see the example in there. Downtrending market, we go sideways. The big thing is a downtrend. Sideways, open interest increase, that's a sell point. That's a setup to sell. By the same token, a big uptrend market goes sideways, open interest decreases. Commercials are covering their shorts, you want to be a buyer. That's a setup for the Commitment to Trader report based on open interest. So we have two ways of looking at the commercials. We have their net position, and then we can put it in the index as we did. And we can also look at the open interest position to see is that open interest increasing or decreasing. And my work shows that a decrease in open interest tends to be bullish, an increase tends to be bearish. But the big thing is, and this is the secret of it, if you will, it's the trend. You have to look at the trend coming down sideways. That's the only time I use the open interest play. The trend going up sideways, then I look at open interest. I don't look at open interest every single day. It's got to fit into that pattern. Once we get into that pattern, then we can take action in the marketplace. But it's got to be in the pattern of down, sideways, open interest increasing. And then you can just sell any breakout to the downside or whatever you're interested in doing. Just any sell signals that develop in that pattern will work for you. Now we have total open interest and individual contract open interest. We want to use the total open interest, which is reported in Investors Business Daily, Wall Street Journal, Great Falls Tribune, whatever town you're in. Look for the total open interest. When that increases by 20% in a trading range, look for your sell. When it decreases by 20%, look for your buy. So we now have an insight into who moves the market, the commercials, and how we can read what the commercials are doing in the marketplace. Have a little bit more I'll teach you in the next tape about commercials, and then we're going to get into how the markets move, the structure of the marketplace, so we can actually take buy signals and sell signals and get into the market. So you can stop your videos now, rewind, and I'll see you in the next videotape.